13,000 people inside a rocket factory are about to wake up set for life. The biggest IPO in the history of the planet goes live in just a few days, and the only question is whether regular investors can secure a seat at the table. This chart tracks the company's valuation over the last year and a half. In roughly 18 months, SpaceX multiplied its worth by 5, jumping from $350 billion to a targeted $1.75 trillion. But look at the bottom of the chart. That massive trillion-dollar valuation line sits on top of $18.7 billion in actual revenue, a tiny fraction of the overall price tag. And on a bottom-line accounting basis, the company posted a loss of nearly $5 billion. They are looking to raise $75 billion in this offering. For context, the previous world record for an IPO was the literal oil company of Saudi Arabia, which raised about $29.4 billion. SpaceX is taking the old record and more than doubling it. Direct, warning tone. You have a dominant space launch monopoly, but you are paying well over 100 times its current revenue. You have to decide if you're buying a great company or severely overpaying for an expensive stock. People line up for these specific events because the math historically favors early arrivals. When beloved tech giants hit the public market, they routinely generate massive wealth for the people already holding equity. Look at Google back in 2004. That public offering reportedly turned around 1,000 employees into millionaires. An in-house massage therapist took stock options instead of a higher salary and retired wealthy. Amazon went public in 1997, while Wall Street openly mocked them for refusing to turn a profit. $10,000 invested on their first day grew to $16 million a couple of decades later. Even Facebook stumbled hard out of the gate in 2012, dropping for months. Yet it still minted fortunes for insiders who held their ground. The catch is that red team investors usually only get to buy in after the easy money is made. But SpaceX is structurally different. They are carving out 30% of this massive offering specifically for regular retail investors. The room finally has a seat open for you. But walking through that door without getting crushed by the hype means picking exactly how you want to buy in. Here are 4 options. Route 1 is a direct IPO request through your broker at $135, but demand is high and supply is capped, so you'll likely get fractions or nothing. That pushes most to Route 2, buying on the open market. You get exactly the amount of shares you want instantly, but you are paying the highest, most frenzied price set by excited buyers. You're acting as exit liquidity for institutions. History tracks this clearly. Across thousands of public offerings, the data shows that highly anticipated stocks frequently drop 20 to 40% in the months immediately following their debut, as the initial excitement cools. Route 3 operates completely behind closed doors on the pre-IPO secondary market. Platforms like Forge let you buy private shares from employees cashing out early. To enter this market, the SEC requires you to pass a strict legal test. You have to be an accredited investor. You must pass a strict financial bar, over $200,000 in income or $1 million in net worth. These 1982 limits were never adjusted for inflation, meaning this strictly enforced rule legally blocks out 82% of American households. If you do clear that bar, you still have to navigate opaque pricing, where different platforms charge drastically different amounts for the exact same share in the exact same week. It is a VIP room, but it is expensive and full of fine print. Route 4 bypasses all those restrictions using publicly traded proxies and funds. The most reliable option available to anyone with a brokerage app is Google's parent company, Alphabet. Alphabet currently holds a 5 to 6% slice of SpaceX. Buying Alphabet stock means zero speculative markup, but as the chart shows, that slice is a tiny fraction of Google's massive business, heavily diluting potential gains. For highly concentrated exposure, you can look at closed-end funds that explicitly load up on SpaceX shares, like the Destiny Tech 100 Fund, ticker DXYZ. Before buying in, you have to understand how these funds actually function by looking at a metric called NAV, or net asset value. This is the genuine mathematical worth of the actual assets inside the fund. The actual assets inside this fund were worth $20 a share, but retail investors drove the market price to $60. You're paying a massive enthusiasm tax. When the hype fades, that $60 premium always collapses back to reality. Using proxies completely removes the IPO allocation lottery, but it forces a rigid trade-off. You either accept heavily diluted safety with Alphabet, or you take on dangerously overpriced concentration with a specialized fund. The most effective strategy available to you is simply doing nothing on the first day. The post-IPO calendar is entirely predictable and offers far better moments to enter. This timeline tracks the rest of the year. Notice the massive warning flag in December. That marks the end of the lockup period, when insiders are legally allowed to sell large chunks of shares. When that massive flood of newly unlocked shares hits the open market, it frequently causes a sharp dip in the price. This timeline is exactly when the scammers will hit. If you get unsolicited offers for private crypto tokens or exclusive pre-IPO access, ignore them. Real shares are only sold through strictly regulated brokerages. Your strongest defense is patience. Letting frantic initial buyers overpay on day one protects your capital and positions you perfectly for a much cheaper entry point a few months down the road. Let's map your exact strategy. This decision tree breaks your choices down into 3 specific paths, based entirely on how much risk you're willing to take. First is the optimizer path. You use dollar cost averaging, breaking your cash into smaller chunks. You buy a little after the dust settles, a little more after earnings, and save cash for the December lockup dip. Next is the conservative path. You buy Alphabet stock. You get indirect exposure to SpaceX's growth, but your money stays anchored to a highly profitable tech giant, completely avoiding the daily price swings. Finally, the speculator path. If you genuinely want to hit the buy button on day one, you keep the position incredibly small, no more than 1 or 2% of your total portfolio. That sizing protects you. If your 1% allocation triples, you have a fantastic financial year. If the stock craters, your actual life, rent, and emergency savings remain completely untouched. Whichever route you take, remember what you are actually buying into. You are not betting on a quick quarterly flip. You are funding a 30-year mission to put human beings on Mars. Thousands of people are cashing in on a generational wealth event. Getting a piece of that for yourself requires keeping your enthusiasm in check, picking a firm strategy, and executing exactly by the math.